Starts your life.
Respected Chairman of SIRC, Srinivasan sir, in absentia, and respected Speaker of the Day, Sri C.A. Keerthi Ganesh, and the respected members of the profession who are attending this program. Namaskaram to you all. Namaskaram, sir. Keerthi Ganesh, sir. Namaskaram.
Namaskaram.
Yeah, this is a beautifully coined program, a basis to valuation and company valuation. We are now trying to specialize in whatever we do, and in that way the valuation has come as a specialized subject now, and that is how this subject has been taken for a special 2 hours program. And I now introduce our speaker of the day, Sri Keerthi Ganesh. Is a chartered accountant who was passed in May 2011, and he is also SIMA UK 2012, and he has got work experience. He is specialized in handling statutory audits with exposure to Indian GAAP, US GAAP, IFRS, and Singapore FRS, SOX reporting. And he's got work experience in internal controls of big automobile companies, in pharma company, including pharma companies, and statutory audit of private insurance company, manufacturing and startup companies. And he's a team leader in audit of listed companies. And his extracurricular activities has been a school hockey team player and has led the team. Wherever you have gone, I think you have led the team, even in the audits and also in the team. I mean, hockey is sports also. Inter-zone level for the first time, and he has volunteered for teaching low-income group, which is a good subject. Good thing you have done. Under the age of Bhumi NGO, and organize a secret Santa program which involves gifting underprivileged kids for Christmas. Yeah, and is in several interdepartmental cultural event and has won all the overall trophy. Thank you, Keerthi Ganesha. And now I introduce Mr. Keerthi Ganesh, sir, and he'll be taking the next 2 hours. Thank you, sir. The forum is yours, sir.
Thank you, Sundarajendra. Thank you for the kind words. And I would like to start by sharing the screen now, so that we can go ahead and start the session. Yeah. Okay. So hope everybody can see the screen now. And good evening to one and all for joining this session. My name is Keerthi. Like Sundarajan sir said, I'm a chartered accountant, cleared in 2011. I used to work with ENY, and then I started my own practice. Now I'm a partner at Rajagopal and Badrinarayanan. I'm also a registered valuer, and I've been involved in various valuations over the past 4-5 years post my clearance. Just to give a quick brief as to what one can expect from today's session and what my objective is with respect to the next 2 hours. I wanted to kind of give you guys a basics to what's happening in the valuation vertical. Why is it required? And more importantly, I wanted to target the practical aspects of valuation, which is the company uh, under the company valuation, and probably impart some of the external resources that I use to conduct the valuation. So my agenda for today is entirely to discuss on all the intricacies in valuation, rather than go and say why a valuer, what a valuer, and go under the Companies Act and rules, right? So we are going to talk about a lot of interesting stuffs relating to cost of debt, cost of equity. Where do we get these numbers practically? How do we conduct evaluation in different scenarios and different examples? So I hope, I mean, my only agenda is to post this session uh, uh, if you have learned 2 or 3 things which you did not know, or which might be useful in your valuation exercise. I'll be happier, and if I'm able to uh, impart the interest under this, and if people take up this course as a specialization, I think I'll be happy. Okay, now of course, before getting into these practical aspects and um, the company valuation, let's just quickly run through the requirements and where does it stem, where does this valuation stem, what is a registered valuer, how do I become a registered valuer. So that we'll quickly run through that, and then probably get into the business valuation and the practical aspects to it, right? So I just wanted to start by saying that what is a valuation? Like, it's just not valuing a share, right? We can value anything. We can value um, in current scenario, you can also value kind if we are money minded, right? So, but that that being said, the definition of valuation is the process of determining the economic sorry, once again. So valuation is the process of determining the economic worth of an asset or liability under certain assumptions, which are properly defined, and limiting conditions, and subject to the data available on the valuation date. So I've highlighted some key words here, which are very important in understanding the concept of valuation. Right. So first, you're trying to determine an economic worth in money terms. But how are we going to do it? Because valuation, to start off, I would say it's very subjective, right? So when I say subjective, that's when the criticality of assumptions come into place, right? So there are certain assumptions that are associated in deriving a value of an asset or a liability. So if these assumptions differ, of course, the value of that asset or liability is going to differ. But how close are the assumptions to reality is what determines the quality of the valuation, right? And then there are also these limiting conditions which are associated to these assumptions, right? We can only assume or estimate certain things up to a certain level. We cannot be 100% sure. We cannot put our foot down and say that this is the right method, or this is the right way which we should treat this, right? So there are limiting conditions to it, and of course it is dependent on the data which is provided by the client. Okay. Why data is I mean, without data we won't be able to do. Why highlighted data is that we need to do due diligence on the data, and we should not just take the data as it comes from the client or from the party from who the valuation is required to be done, right? And the fourth segment is the date at which we do the valuation, right? So which is also very key, because your assumptions and limiting conditions are going to be based on that valuation date. So the question is, can I do a valuation for 2021 now or 2020 now, right? Of course you can do a valuation for 2020 now, right? So because you are only determining the economic worth of that asset or liability as on a specific date with the assumptions and limiting conditions which are associated to that date, right? Now the only added advantage here is now your assumptions and limiting conditions are going to be very close to reality because you've seen 2 years past the valuation date. Now so like I said, with these things culminated, valuation is still a subjective mechanism. And I always like to say this, that and I always like to set the context that see, in all practicality, you know that the the buying side and the selling side or your client always, or in most cases, comes up with a number and says that uh, maybe this is what we are looking at. So it's not completely wrong that two parties have already decided a number and then they are coming to a valuer to get the valuation done, right? No, it only gives a sense of what the two different parties are thinking, right? And where are they coming from, which can be used in your valuation exercise. So we are not only doing just a paper exercise to determine the value of an asset or a liability, right? And just using for regulatory purposes. No, I always say this, that we are giving a scientific approach to the valuation, to the value. Like, you're giving a scientific approach to the value, and you're ensuring that this scientific approach makes complete sense for whoever is seeing the report, or whoever is going through the valuation, or who wants to understand how this value is arrived, right? uh, it can be a predetermined number between two parties, because end of the day they are two unrelated parties who have already decided a number. So of course it can be termed as the fair value, right? But you're only giving a scientific approach to ensure that this fair value makes sense and is reasonable, considering all the things surrounded to it, and it doesn't look very off either on the plus side or on the minus side. So this context being said, let's get into the valuation vertical. So valuation can be done for, like I said, it can be done for anything with related to finance, asset, or an liability. Let's restrict ourselves to that. So here our valuation as a service is required in mergers, acquisitions, IPOs, conversion, takeovers, buyback, ESOPs, intangible assets, corporate restructuring, court mandated valuation, arbitrations when there is a dispute, and it all these are also covered in different acts and different um, laws of SEBI, RBI, Income Tax, and Companies Act, of course. So today, my concentration is going to be, because my view is, a lot of us are into valuation, a lot of us end up doing more of company valuation, and for issue of shares, or mergers and demergers, or buyback. So my objective was to try and see the practical side on that. So we are going to just run through the regulatory requirements of how to become a valuer, or what are the rules and the act, what are the rules and the act says. But just quickly, I don't want to deep dive into sections and things like that. We'll just, so that I just want to give a heads up that these are the things available. Anybody can go and research. I mean, just go look at it in the net and then try to figure out what it is. I just want to give a heads up saying this is where you can look at, so that all of you are aware that you can go here and get what you want, right? Um, like I told you, valuation is covered, valuer, registered valuer, valuation is covered under section 247 of the Companies Act. And there are also the other applicable rules are, one is there is a separate rule for companies, registered valuers, and valuation rules 2017. And there are also valuation standards which have been issued by ICAI, and there are also international valuation standards. Right? Now, broadly, now the current framework is that um, there needs to be there is a separate registered valuer organization which conducts the examination to become a registered valuer, and you will have to follow the standards prescribed by the registered valuers organization, and then you become a registered valuer, and you can sign or do valuation and attest on as a registered valuer. So the broad ambit to become a registered valuer. Your Companies Act requires mandatorily a registered valuer for valuation. However, that's not the case with other acts like FEMA or Income Tax Act, where under FEMA, you being a CA, you can still give a valuation certificate for shares and as per the pricing guidelines. And under income tax also, as a CA, you can, although specific certificate is not required, you can still sign off as a CA for preference shares. And for equity, it's more of a formula based driven, right? So this is the broad context as to the valuation regulatory framework, right? So critically, I just want to touch those big things. One is the Companies Act, then you have FEMA, which we usually get, and then you have this Income Tax Act, right? But in being a registered valuer, you are required to follow your company's registered valuation rules, and specifically the valuation standards adopted by the your registered valuer organization, right? Yeah, like I said, it's our registered valuer comes under Companies Act, SEBI, Securities Exchange Board, Insolvency Bankruptcy Code. IBC is the new wave, which requires a lot of valuation and giving a lot of opportunities for us. Yeah, this is I'll share this slide subsequent to our session so that you can just run through, and then this slide tells you the applicability of registered valuer under the companies, where all we need a valuation report from a registered valuer. Okay. Specifically, if you see, one thing to note here is rights issue is not covered here. Okay, so that is something which you can note. Then the IBC code also requires a valuation from a registered valuer. Okay. Now, the Companies Act section 247 covers valuation of property, stock, shares, debentures, securities, goodwill, any other asset. Then you can do net worth and liability. These are part of the definition which comes under the Companies Act. And it also says that it should be valued by a person having such qualification and experience, registered as a valuer, member of an organization recognized, like I told you, and manner and terms as may be prescribed. These are prescribed in the rules, and appointed by the audit committee or board of directors. So this is very critical. I think some of us don't ensure that it is being done, but any valuation needs to have been appointed by the audit committee or board of directors. This at a practical level, it's difficult when we do valuations for private limited companies, but we should ensure that we try and get the approval or appointment done by the board of directors, right? Now, quickly running through the sections of the Companies Act, the requirement is we should be impartial and do a true and fair valuation of the assets. Exercise due diligence while performing the functions as valuer. We'll deep dive into due diligence and the practical aspects of it in our future slide. It's more on the due diligence is required on the data which we receive, right? And the overall what are the procedures to ensure that the data is correct, and whether we have obtained adequate information and explanation from the other side. Make the valuation in accordance with the prescribed rules, and The other important thing is we should not undertake any valuation if we have a direct or indirect interest, or become so interested at any time during a period of 3 years prior to his appointment. Now, direct is fine, indirect is little subjective, so not going to deep dive here, but just want to let you know that when you are valuing a company, ensure that you are independent and you are not connected in uh, in any manner or so, right? Uh, the section also gives the contraventions and the punishment for non-compliance of these the previous things which we discussed, ranging about 25,000, 1 lakh, and we are also required to refund the remuneration received if we are liable for any non-compliance. Right? We'll quickly run through the rules of rules prescribed for valuation under the Companies Act. The rules are broken down into chapters: preliminary, eligibility, qualification, 3, 4, 5, 6. There are about 20, 21 rules. It's again applicable for properties, stocks, shares, debentures, securities, goodwill, and any other assets, net worth, or liabilities. Okay. Here, what you should know is there are uh, 3 asset classes under valuation. One is land and building, one is uh, plant and machinery, and the other is financial securities and financial instruments. Right. Um, so when you want to become a valuer, there are specific examinations for these verticals, and most of us try and pick up the securities and financial instruments, which covers the shares or any items in a balance sheet, intangible assets and things like that. Land and building is a more specific valuation. A lot of engineers do that, and then they're well versed with determining the fair market value of a land and building. Plant and machinery also is more technical and trying to determine the fair market value, or the value, economic worth at a given point in time for a particular set of assets. Right now, why this segregation? There is some level of technicality involved in specifically valuing these assets, which I think may not be, which I think which requires a little more attention and detail, and hence you have these different verticals. And in practically, we Hello.
Yes, sir. Can I
Sorry,
turn on
sir.
a video? No problem, no
Yeah.
problem. Sir, just to inform you that for last 5 minutes or so, that is, she would have called you, right? The last 2 minutes or
Okay.
3 minutes would have lost. Actually, I'll give you the presenter right, sir, if you want.
Sure, sure, sure. Done.
Now we can share this.
Yeah. Shall we continue?
So,
Yeah. Yeah, let's continue. Extremely sorry, audience. I think I had a network issue at my end, so I think that's the break. Really sorry. So I was telling that we were going through the rules. We were going through the rules which were prescribed under the Companies Act. I don't want to get into details of the rules. I just want to run through and ensure that you guys are aware that there are things like this under the rules, and you can go ahead and read about them at a later point in time. Okay. But however, I was more I wanted to dwell about this contents of valuation report. Like we have ICAI has its own valuation standards, which are like a subset of the international valuation standards, and these are also prescribed in the valuation standards. And being a CA, even if you do a valuation, you are required to follow these standards and ensure you are compliant with the rules as well, right? And critically, our valuation report should contain this background information of the asset, purpose of the valuation, purpose being the very key, because purpose determines the method of valuation that we are going to undertake, right? We are the purpose of valuation will uh, also determine the assumptions and the limiting conditions associated to the valuation. We'll deep dive into this segment at a little later point in time. Then we also have the identity of the valuer, disclosure of the valuer interest. If no, we still have to say that. Date of appointment, valuation date, date of report, inspections, investigations undertaken, part of our procedures, nature and source of information that we have relied upon, procedures adopted to carrying out, restrictions on the use of report, major factors like major factors that we have taken into consideration during our valuation, more like an EOM or a significant item that we need to disclose. Then the conclusion, which is our valuation and what is the number, and also the caveats, limitations, and disclaimers. Although there is no specific format associated or any format given in the standards or the evaluation rules, but these are more mandatory segments that needs to form part of the valuation report whenever we sign as a registered valuer or as a CA, right? There are other rules which covers temporary surrender of registration certificate, transitional arrangements, eligibility for registered valuers organization, application for recognition, conditions of recognition, more on the organizations. Then you have the valuation standards, uh, applicable valuation standard, and then you have committee to advise on valuation matters, right? So now what we have seen now is the Companies Act requirements and how and value what are the things covered with respect to valuer, registered valuer, and also the rules associated to it, right? Then we also have this third segment of valuation standards, right? Currently, I think there are recent new international valuation standards are also there now, which has recently come out. But let's not get into that at this point in time. Maybe we'll just run through the later segment. Okay. Now, for our critical aspects, which I wanted to personally cover and try and give you some value add to the existing knowledge that you guys have, is on this business valuation and company valuation, right? I'm sure we have got a lot of assignments for valuation of shares primarily, or valuation of intangible assets, valuation of the company, valuation of the business, valuation for net worth certificates, valuation of startups, valuation of mature companies, lot of different variations, lot of businesses, right? So we are going to target and see how do we assign a process to this business valuation, and what are the things we should consider in this process to ensure that we do a quality valuation, and ensure that our scientific approach to deriving the value is very closer to reality, right? Moving forward, like I told you, valuation is subjective, right? And business valuation is beyond the numbers. It is not just fitting in numbers into a model that comes out, that throws a value and that becomes the value of the business. No, right? You should understand the macro and micro business impacts of the company or the business, right, at a first level, to understand the business model of the company. Um you also need to know what are the other critical laws that may impact the business or the company, right? There could be land ceiling act, there could be environmental act, which can impact the value of an asset, right? Or to which will impact the assumptions that we are taking. We should also know the financial risks and the returns, and other business risks associated to the business that we are going to value, right? Of course, we should also give importance to the past data, which is our key indicator of how the future is going to pan out, right? So we should understand the past data as well, so that we understand how the business has fared in the recent past, so that we take up correct assumptions and correct methods in valuing the business, right? So apart from just seeing the P&L, balance sheet, and the projections that we get in kinds of uh, in cases of doing different methods, we should also assess the business aspects and other surrounding aspects of the business to ensure that we do a good valuation exercise, right? So just to give you an example, right? So if I want to fix the life cycle of a companies and say how it impacts the valuation and where all things could change, right? So if you take a startup company, you should understand the nature of, you should know that yes, this is a startup, not because of just being a company incorporated. No, the business can be a startup by itself. The company can be in existence for a decade at least, right? But the future can fall under a startup category, what the company is looking to do and where we are trying to value the business or the value the company, right? In that case, your turnover or profits are going to be negligible, and there are not going to be much of a proven track record as well, right? So in this case, your assumptions and your estimates and the discount rates and the cost of capital that you use are going to be very high. Basically, it boils on the fact that your risks are very high because the business is only growing, and uh, uh, the threats to the business are more than the opportunities, right, at this stage, like from a finance angle, from a customer acquisition angle, and things like that. So when you go to a growing company here, although you're still not ascertained, you're still not sure about the turnover or the profits, but you do have some proven uh, track record, and accordingly you fine tune your assumptions and your setting of capitals and your due diligence on the past records and the future projections, right? And then you have these high growth companies where it's a very safe space. Your high growth and mature companies are very safe space where you have good amount of past data, and there are not, in many cases there are not going to be significant changes into the future, so you can apply your past metrics and analytics into your future and try to get a comfort there. and your assumptions and your estimations, you will have some comparables in the market which you can use and try and use in the valuation, right? And then when you come to the last cycle of declining companies, there again, see, this is very critical, because only if you understand the business and the where it is and the risks associated, you will be able to appreciate whether the company is in a declining stage or in a growth stage or a mature stage, right? So basis that, we'll have to determine our again, I keep going back to these assumptions and estimations because of the subjectivity involved in a valuation exercise, the methodology and those aspects, right? So understanding the business and understanding the business helps you in determining lot of aspects, which helps you in finalizing on the right methodology and the right methods that you have to apply to derive at your valuation, right? Now, like I said, in whatever valuation we do, I think we should follow these processes and ensure that we cover these segments without before we kind of conclude the value of an asset or a business, right? First, like I mentioned again, the criticality is the purpose of valuation. I'll tell you why purpose of valuation is very important, because a purpose of valuation can change the value of an asset at the same time interval for two different valuers, right? So for example, if you have two people trying to value the same asset, but the purpose of buying that asset is different for these two individuals, right? Then accordingly your assumptions and your methodology may differ, right? So this is why your understanding the purpose of valuation is very, very, very critical, and this will come from either from the company or the person buying the asset or selling the asset. So it can come from any side. So you should understand what is the purpose of valuation before we conclude on the methodology and other assumptions. Now, purpose of valuation includes whether it is for a transaction, whether it is for a regulatory requirement, or it is for a reporting purpose. What is it, whether it is a short term or a long term time horizon that we are looking at, right? Who is asking whether it is for getting a minority stake or whether it is getting a controlling stake, right? And whether they are requesting for an enterprise value or an equity value, right? So these things we can try and check. We'll try and see what are these enterprise value and equity value later, but so these are the things which goes into a purpose of valuation, and you should first understand the clear purpose of valuation before we get into the other processes. Now you should also determine at this point in time what is going to be the premise of value, right? What are the assumptions that you're going to take? But critically, you should first understand whether it is going to be a going concern valuation or it's going to be a liquidation valuation from a business point of view, right? Going concern is much easier because you know that there is a future to it, and you have to accordingly project the future and try to adopt a specific method which inculcates the future economic benefits, right? And then you have this another liquidation segment where you try and use you try and see how best we can value a business that is getting liquidated. There you will have to see the two things which you'll have to factor in is whether it is value in use or value in exchange. You try to determine the value, what is the best way to do it, right? Value in use or value in exchange. Value in use is nothing but what is the value you derive by using the asset, right? And value in exchange is something like a barter system, like in place of this, if you're able to get this, then that becomes the value, right? So these are the two broad concepts under premise of value, which again joins to our initial segment of purpose of valuation. So once this is clear, right, once we are clear about this segment, we are clear about the purpose of valuation and the premise of valuation, then we get into the next process or next step in the valuation process, which is collecting the information, or what information should we request from the company or from the business that we are valuing. Okay, and what are the analysis and adjustment that needs to be undertaken to the data that has been received for the purpose of valuation, right? Now the financial information requires you will have, there are, see, again, once you know what the business is, you will have an idea of what to request, and some of the things that you should mandatorily ask and try to get an understanding is, of course, the annual reports, management discussion and analysis reports, accounting policies and disclosures, auditors report, related party transaction, segment reporting, other aspects, right? Other aspects of a business, or other aspects, other financial aspects that you may want to know, right? And if it is closely held companies, you want to, and it is being purchased by a third party, you want to like try and ensure that the earnings, what has happened is normal in nature, it is fair in nature, right? And it's not going to change in the future because of related party transactions, right? So we'll have to ensure specifically on related party transactions. Okay, then you also ask or analyze specifically into what are recurring and non-operating items that you may have to segregate and see, right? So typically we all start with getting the financials, getting running through the numbers, understanding the business, and asking the team as to what are they going to do in the future, right? So from the past data, you try and analyze trends, and you assign ratios and see, okay, this is what the company is this is how the company has been run, this is how the business has been run, and going forward we'll have to try and ensure that we maintain those ratios and metrics, right? And we also understand, like, okay, within the balance sheet and P&L, these are the non-recurring items, these are the non-operating items. This we need to ensure how we are going to factor it in the future if it's a going concern basis, and if it's a liquidation basis, how are we going to factor, how is it going to generate cash, or how is it going to generate economic worth at the given point in time, right? So all these form part of my financial analysis and normalization, any adjustments that you want to consider, right? So moving on, the third step under the valuation process is understanding the industry and trends, right? This is this is slightly internal as well as external, right? So one is, you, like I said, you understand the business and things like that. You also understand the industry in which the business is running internally, how the business is faring, but you also understand the how the industry and market as such is doing from an external perspective, right? How do you, and how are you placed in that market, and how are the generic market risks and rewards and returns are getting applied to your business, right? So this is also very critical, because end of the day, we are trying to, most of the cases we are trying to do a valuation based on our projections, and my future is always going to depend on the macroeconomic factors of the industry, of the market, of the country, right? So I should understand how where, which market I am, which industry I am, and get an understanding of that industry and markets, and also understand the trends of that industry. So generically, what we do, what I do in my reports or in my segments, my valuation exercise is that I try and download the market study reports of the specific industry or the specific market that the company or the business is situated, run through the market study report or run from the net, and so that gives you a average growth rate for the next 5 years, and what are the challenges that they're facing, or the changes that are expected to this business which may affect your projections and assumptions. So on a practically, we just try and see if there are any market study report, and then we also give a segment of that industry review and market study in our valuation report, saying that this is how we have analyzed the market, and then we are comfortable with the projections that we are that we have used for this valuation, right? So like I said, you are only giving a scientific approach and determining a number. So it's just not that number. You should also ensure that you don't question in the the whole scientific approach. You should be able to answer your every assumptions, your every call that you're taking to arrive at the valuation. The next, once you get the, like I said, once you get the data, once you analyze, and then you get into determining what is the uh, um, appropriate valuation methodologies that are required to perform the valuation per se, which we'll deep dive into in the next segment, right? So there are you must be aware that there are multiple methods: income approach, market approach, cost approach. We will deep dive or run through these things, and I will let you know that there are methods like this, there are uh, um, uh, approaches like this, so that you can take an informed call when you do the evaluation. Of course, you can always get back to me later, or you can do your own research to complete the process. So my objective is to just tell you that these are the things available, and you should follow this process as a guideline mechanism, so that we ensure that the compliance is achieved, right? Now, subsequent to getting the data, understanding the industry, you get into the actual valuation exercise. You analyze the company performance, do the due diligence, appropriate method, valuation method. You determine the appropriate valuation methodologies. You determine a number, right? So after determining the number, you also need to do and ensure that, do we need to do any certain adjustments to this valuation arrived based on specific key scenarios, right? So for example, once you determine the value of a business using the various method, you should also look at, there are certain value adjustments that needs to be looked into, like should we assign certain discounts or premium because of the nature of the business. So there are certain discounts, like which we use a key percent discount, or a contingent liability discount, diversified company discount, holding company discount, liquidation discount. Okay, and there are also premiums and discounts with respect to lack of control or lack of marketability, and control premium, which is the opposite of lack of control. Now, these are some things I think most of us don't provide in our, while we conclude our valuation, right? So this is something additional that you may consider when you give a when you complete a valuation. For example, what do we mean by key percent discount, right? Key percent discount is something where you feel that the business is run by a very key person, and without this person there could be a significant impact on the business, right? For example, when you're valuing a restaurant, when you're valuing a restaurant business, the revenue which has been achieved over the last 5 years may be because of the owner or the chef who's there in that restaurant, right? And once, if somebody who's going to buy this restaurant based on these revenues, and if the same chef is not going to continue at the restaurant, then there is a possibility that the revenues are going to decline in the future. Okay, so then you also give a fact that you also give a overall discount, saying that there was a brand image associated to the chef, and which may not continue to the in the future, right? And so there, that is a key percent discount, right? And then you have a contingent liability discount where you feel that there are a lot of cases pending which are not yet concluded, where you don't know the quantum of liability that may arise at a later point in time. So but you estimate a percentage, or you estimate a number and say this is the discount we want to provide for the valuation, because there are a lot of these contingent liabilities associated to this company or to this business, right? Then you have a diversified company discount. This could be both, right? You can, it's very subjective, right? So as a company, it has lot of multiple business verticals, and when you're trying to value the company as a whole, either you give a premium saying, see, the risks are diversified, or you say that my returns are not going to be that great because it's all diversified, so it's going to be only average. So it's very subjective. It also is also based on the purpose of valuation, like I said. There are other things like holding company discount, where the entirely it's just a holding company, or there is too much dependency on the holding company for its revenues, or for its operations and things like that, right? These are certain operational level discounts that you can look into. The other aspects are critical, which may be, see, what we have discussed now may not be applicable for all the valuation, but what we are going to see now may be applicable for most of the business valuation, right? Your lack of control and marketability, right? What is lack of control? Like if somebody wants to acquire more than 24%, he's getting a controlling stake. If so, there is a difference between an investor who's going to acquire 5% of a business than a investor who is planning to acquire 25% of a business, where he's getting some level of control, right? So you either try and give a control premium to that valuation, or a discount discount for the lack of control, right? So the value of shares for a person owning 95% will be slightly different from a person owning 5%, right? So this is where again the purpose of valuation comes into place, right? Lack of marketability is predominantly factored for private limited companies, because it's difficult to sell the shares of a private limited company, right? So you assign a certain amount of discount for this difficulty. Like tomorrow, being an investor, I'm not, even if I invest in your company, I have very limited market for me to sell these shares outside. So there is a lack of marketability for the shares, unlike a listed company shares is freely tradable, right? There you try and give a certain value adjustments to uh, the business, and conclude your valuation, right? So these are some of the value adjustments that you can consider when you do your valuation based on the business understanding and the purpose of valuation. The other types of value adjustments also comes from your straight financial aspects, right? So in your financials, you will see that there are going to be operating assets and there are going to be non-operating assets, right? So you will have to identify what are these operating assets and what are these non-operating assets. See, as a business, it could be a going concern, but there could be certain assets which are non-operating, and accordingly you need to value them so that either the value is reduced or added to the business value. Okay, so a typical example would be that there is a factory situated in a huge parcel of land, and the market value of land is very significant as compared to the business of the as compared to the business itself, right? But the factory is running only on 25% of the land, right? So it makes sense to say that your 75% of the land is a non-operating asset, and that should be valued separately and should not be included as part of the business valuation, right? Because you can if you do certain changes, you will the company will be able to sell this balanced land and still run the business without any damages, right? So then you try and determine what are these non-operating assets and try and assign a value to these non-operating assets. Okay. So these non-operating assets can be investments, your mutual funds, your fixed deposits, vacant land, um, um, any other item sitting in the balance sheet which are not directly attributable to the operations of the business and things. Okay. So these are the other value adjustments that you should also look at in performing a value of the business or value of the company, right? So because end of the day, your value of a share is going to be determined based on the value of the business, right? You first determine the value of the firm or equity value and just divide it by the number of equity shares. So so you need to understand and do these value adjustments in completing your valuation, right? We'll just take a quick 2-minute water break. Okay. Just checking my net here. Okay. Thank you. Let's get back to our session. So like I told you, we have looked into the process for a business valuation. Like my objective is entirely on how do we practically approach our valuation. I'm not too, I don't want to get into the acts and the rules of it, right? So I want to be as practical and I want to target those issues which we are all facing day to day. And any questions, we'll definitely pick it up at the end of the session. So like I told you, right, to just to give a recap, right? So we should try and follow this process, valuation process for any valuation that we do, and it flows. Step 1, understanding the purpose of valuation. Step 2, step 3 requires getting the data and analyzing the data, doing the due diligence. And then step 3, also looking at the industry and market. Step 4 and 5 are the key valuation methodologies, determination of valuation methodologies that we need to do. Step 6 is also very key on any value adjustments that are required to complete the valuation. Now that we have seen the other segments, let's deep dive into the different valuation methodologies and valuation approaches that are in place. And like I said, again, we are going to deep dive into specific business valuation or company valuation, and specifically on the discounted cash flow method, right? Which is the most prevalent method that we use to value any cash generating asset or a company or a share, right? However, just to give an overview, so there are two approaches, right? One is the fundamental approach and one is the relative approach, right? And there are also other smaller methods associated to this, right? Your fundamental approach covers both the income approach and the asset approach, right? Your income approach includes your discounted cash flow method based on your projected cash flows and the time value of money. Asset approach is determining the book value method, liquidation method, replacement value method, right? We will deep dive into discounted cash flow method. Now, little more dwelling on the asset approach. See, asset approach is technically when you want to identify a particular asset, or when the business is significantly asset rich than in comparison of the business by itself. Okay, in that case, you still do a mix of two approaches, or where there is where the business is not started or it is going to liquidation mode, you try and get into adjusted book value method. So you try and determine the why I say adjusted book value method is, we try and determine the fair value of each asset and liability. So some could be straight from the books and some could be determined based on any other method, appropriate method. Like if there is a land, you can try and get the guideline value or the market value, whereas the holistic approach of determining the business could be the asset approach, right? Next, from a relative approach, market-based approach is covered, and this market-based relative is more like a comparable, right? You just try and relatively how is it doing, relatively how is it performing, right? So here your market-based approach covers comparable companies market multiples method, comparable transactions multiples method, and your market value method, right? Market value is simple. It's for quoted securities. You take the market value of per share and then determine the value of the business, right? So comparable companies market multiple is so you try and see what who are your peers and who are the comparable companies that suit your business and your size of operation, and see how are they valued uh, um, in the market, right? So then that you can apply, like let's take a revenue multiple or an EBITDA multiple or a PBT multiple and say that, see, these are the 5 companies I've decided that these fall into my comparable companies, and then I'm taking these multiples and then trying to say that my business or my company is valued like that, right? It's a very subjective method, because like I'm sure a lot of us have done this comparable companies for our transfer pricing as well, right? When we do our transfer pricing study report, we take comparable companies and in both your cup or your TNMM and say that my margins are similar, right? So you would have seen that there are a lot of factors which goes into arriving and deciding on what is a comparable company. A similar approach needs to be given for determining the comparable companies under valuation also. Just because both companies are under the same industry or the same market they cannot be comparable companies, okay, because their size of operations can be different, their area of expertise can be different, their as simple as their debt equity ratio may be different, right? So all these need to be considered in trying to fit a company under the comparable market multiple. Of course, you're not going to get exactly the same replica of your business or your company. What we are looking at is you can fit into a circle, right? You can fit into the circle of uh, comparables and then ensure that they can talk to each other. Comparable transactions method is very similar to comparable companies, but more like, okay, this industry, this market, this vertical, somebody has invested at this value, so hence my company's value is this much, right? So you can take the recent transactions that has happened. This holds good for both valuing an asset like a land or a plant and machinery, as well as to a share or a business, right? So effectively, if somebody is investing in Byju's, then you have this other competitor, Unacademy. They can say that, see, in Byju's they've invested so much. Then you, or somebody can come back and say in Dream11, if somebody is invested in Dream11, your Game Easy or GameZ or your other online platform can say that somebody has invested in this at this multiple at this valuation. So hence we should also be valued. Again, there should be some comparable terms with respect to size and rights and the market and the business per se, right? So this is comparable transaction multiples method. Market value, like we discussed for quoted securities, right? Then you have other methods like venture capitalist method. So venture capitalist method is to broadly say that what happens is, so if they want to invest, let's say they want to put in 10 crores of money, right, and they have a estimated exit value, they want to get 35 crores at the end of 5 years, right? Or they backwork and see what will be the valuation to get that, right? So it's more of a mixed approach of saying that, okay, I want to get this money at the end of 5 years, I back, and this is the rate of return I want, so I backwork and say how much should I invest for this this returns and this size of company, right? So that is venture capitalist method. Then you have this rule of thumb is more from an industry wise, right? Like you like let's say very broadly you can say that my market value is 20% higher than my guideline value. That's like a rule of thumb, right? My 25% higher than okay, then those kind of industry, like you know that my rule of thumb valuation for like solar power, you know, unit rate, so that's a rule of thumb this thing. So you have metrics like if I put 100 rupees I should get so much in different industries, right? So you can also follow that. Then there are specific two methods for intangible, very limited use, but then yeah, if somebody is doing an intangible asset, they can do this relief from royalty method, where you use the royalty which is going to come and discount it and then derive at the value. Or you can also do this with and without method for branding and for typically to value the brand, right? So you try and see, with the brand I generate so much revenue, without the brand I generate so much revenue. So the value, the difference in value between these two become the value of the intangible asset or a branding, right? So these are the other methods which we can try and apply in our specific scenarios, right? Now moving on, very critically, I think we've all seen like, to give you an overview. So there is an income approach, there is an asset approach, there is a market approach. So based on the process that we have followed and the information that we have collected, as a valuer, you need to determine what is the best methodology or valuation approach that is applicable for that specific valuation. And you should also consider the purpose of valuation and who are we giving the report to, like who is going to read the report. Okay. Practically, we all use income approach, discounted cash flow valuation for any going concern business, right? Which is the most prevalent method which is being used. So what we'll try and see now is how do we go about this discounted cash flow valuation? There are a lot of variables and factors associated to discounted value cash flow valuation, right? First there is cash flow, then there is the discount rate, then there is the terminal value, then the growth rate that you're going to use in the projections. How are we going to due diligence the projections? um, um, what is the debt equity ratio that we are going to use? What is the under discounted cash flow valuation, whether we are going to do for equity valuers or they're going to determine the value of the firm, right? So there are a lot of factors that go into this discounted cash flow valuation, right? So first one, of course, as the name suggests, we need to have free cash flows, right? We need to project cash flows for the future, and ensure that which are going to used, which you are going to discount and arrive at the present value, right? Which in turn is the value as of today, right? So now the difficult part is two aspects here. One, whether the projected numbers are correct. Second is how long do we project, right? So I always stick to a minimum period of 5, okay, which is a very accepted number of years projection. But of course, it can change depending on the specific purpose and business, right? There could be a rental agreement which is there for 7 years, so you as well as do the projections for 7 years and then take the perpetual rate, right? So there are certain things which you can feel that this is more appropriate and this is more suitable for the valuation and makes more sense as well, right? So we generally follow a 5-year period, and after that it's a perpetuity period, okay. So overall approach to discounted cash flow is that you have projections, you determine the free cash flows and you discount the cash flows using the discount rate, and you also assign a terminal value because you're only projecting it for 5 years. So taking the last year's cash flow, you determine the terminal value, and these two together become the value of the business, right? Okay. So like I said, the first important thing is the free cash flow, which we have seen. Let's use 5 years as a minimum base, right? Now see, there are two types of free cash flows, right? In the when you do a DCF method, right? One is the free cash flows to the firm or the business, and the other is free cash flows to the equity holders, right? The difference here is that, okay, before we get into the difference between these two, first, how do we get this free cash flow is, like I said, we start from PBT and add back your depreciation and your other any non-cash items specifically, right? And then you reduce the taxes, your working capital changes and your capital expenditure, and then arrive at the free cash flow, right? So free cash flow can be derived from my P&L. I add back certain items, I reduce certain items. So straight away from a P&L perspective, you can add back your depreciation or other significant non-cash items, right? Like in case of significant provisions that you've made, right? So you can do that, right? Uh, after you do that, you also have to factor in certain cash flow impacts which are coming from your balance sheet, like your working capital requirements, your capital expenditure, right? Wherein you need to spend cash to expand, you've planned some certain capital that needs to be factored in your projections, right? Working capital changes also need to be factored. Working capital changes are nothing but your changes. So the more and more you grow, you might need additional working capital to sustain that growth. So that means you need more cash to pump in to reach that level of volumes or level of business, right? So you need to factor in the change in working capital as well, right? So then this will give you the free cash flows. Now, like I told you, there are two free cash flows, right? One for the firm and one for the business asset, one for the equity. The only difference being is when it is business, that means you are considering the cash flow for both equity and debt users, right? So in that case, what happens is you don't consider anything related to the debt, right? So you don't consider the repayment of debt, you don't consider the interest expense, and you also don't consider critically the tax benefit that is arising out of the interest, right? So hence you start from EBITDA to and make these changes to arrive at the free cash flow to firm, right? Now, how do we arrive at free cash flow to equity? So from free cash flow to if you want to do free cash flow to equity, then you consider the repayments of these loans, consider the interest outflow, right? You determine what is the final cash flow available to the equity holders, right? This can also be done from a value perspective, meaning you can use free cash flow to firm, discount that, determine the value of business, and then reduce the debt outstanding as of now to determine the value for equity holders, right? So this is the most prevailed method that people use, right? So they start from they start from free cash flow to the firm, determine the value of business, reduce the debt to determine the value for equity holders, and then you reduce it by outstanding shares to determine the per value share, right? So now that we have seen how to determine the free cash flows, right, we are going to talk about the discount rate that we are going to use. Again, we are going to see only the we are trying to deep dive into the practical aspects of this discount rate, right? Now, before we start, of course, from a cash flow perspective, what you need to try and do is, as part of our analysis and trends, you should do due diligence to ensure that the projections are reasonable and believable, right? Because the entire value is going to be derived out of these projections, whether the profits which are mentioned and the growth rate which is applied, all these make sense for the business and the market as such. Okay. Now the next big category is the cost of at what rate do I discount the free cash flows, right? Of course, you start off with weighted average cost of capital. Okay, first thing you need to know is you should use weighted average cost of capital only if you use free cash flow to firm, right? If your cash flows are pertaining to equity holders, you should only use cost of equity to discount the cash flow, right? So first, please remember that when it is cash flows to firm, you use weighted average cost of capital. When it is equity cash flow to equity free cash flow of equity holders, then you use cost of equity. So weighted average cost of capital is simple. You just assign, there are two things: cost of equity, cost of debt. Cost of debt is nothing but the interest rate that we pay. Cost of equity has its own formula that you can use and determine the cost of equity. So you assign weights based on the debt equity ratio and derive at the weighted average cost of capital. It's simple, no complications there. You should only, so here only the tricky part is, what if there is additional loan that the company is going to take, which will change the debt equity ratio, in turn changing the weighted average cost of capital in the future years, right? In some cases, what we try and do is we break down the projections, right? you break down saying that um, uh, for first 3 years this is going to be the debt equity ratio, so hence this is going to be the weighted average cost of capital. The next 2 years it's going to be like this, and post for my terminal year it's going to be like this. So if you have definitive information like that, then you can try and break down this projections and say for this period we are going to apply this debt equity ratio, right? So that is one way to do it. Or you assign a blended debt equity ratio for your entire period, right? So this is something which you should need to factor, because most of us miss out saying that, because we use a debt equity ratio which is prevalent as at the balance sheet rate, but we don't consider the changes that may happen in 2 years time, and which can hamper the significant which can have a significant impact of the business, right? If it's going to be 50-50 tomorrow, if it changes to 75-25, your discount rate also changes accordingly, right? Okay, so this you need to factor in and then ensure that you bring it into your valuation, right? And the cost of debt is always the post tax, because you are removing the tax impact in your cash flows, right? So your discount rate also should factor that, so it should always be post tax, right? So that is one. Now moving to your discount rate, which is your cost of equity, right? Now the prevalent mode to determine cost of equity is your capital asset pricing model. The formula for capital asset pricing model is your risk-free rate of return plus your market rate of return minus your risk-free multiplied by beta, plus you also add certain small company risk premium or company specific risk premium, right? So not going to explain this formula as such. I'm just going to give some insights as to why this is coming, right? See, why this cost of equity is factored in this manner is that see, anybody investing in a business wants a certain percentage of return. Okay, you start off with risk-free return because any person investing will want more than the risk-free return, right? So your cost of equity has to be risk-free. Otherwise, why will I do the business? I can as well as put it in a risk-free return asset and then just sit by getting that 4%, 5%, things like that. So risk-free return is generically the 10-year government bond rate which we use generically, right? So this is something to indicate that if I put in money somewhere, I need more than the risk-free return. So you start off with risk-free return, and then what you're adding is, then the next segment for an investor is the markets, right? Equity markets, right? If I'm going to just put in equity market, I'm going to get those market returns anyway without doing anything. Whether it is going to be lower or higher, I'm going to get that market return, right? So I don't have to do anything. So what you do is you add that additional market return to the risk-free premium. Okay, this is the next step. Now, why do you factor in beta, right? Beta you factor because the market return, you are telling this is for the generic market return, whereas you are trying to determine a discount rate for your particular industry or a particular business. So you determine the beta for that industry, that segment, right? And then multiply that to the market return. So you are bringing the market return closer to your valuation, your company's valuation or your business valuation by giving a beta. Like it could be 80% of the market return or 1.120% of the market return, right? So the logic behind it was, if I invest something, I need to get something more than my risk-free return and my market return for this industry, right? So now that's where this that's where the concept of this formula comes, right? So there is a risk-free return, there is a market return, market return, the difference of market return and risk-free return multiplied by beta, and then you also add your specific company risk premium or a small company risk premium for your specific business valuation or equity valuation, right? This will help you in determining the cost of equity, right? See, why do you need to add small company risk premium or company specific risk premium, right? Because you until then you are only factoring the market condition. You are not coming to your own company, right? Your risk free return is a market factor. Your market difference of market return and risk free return is again based out of market data. Your beta is also to an extent market data because you're only covering your specific industry. Now, how do you factor in the additional risks or rewards associated to your own company or your own valuation, right? Your company may need more working capital. So small companies need more branding, more spend on branding, more spend on customer acquisition, more spend on quality. So they've not reached that level. So there is a risk of this product being not clicking, risk of customers not liking this product, risk of market not accepting this product. So I need to associate a premium to that. Then there is also company specific premium, like I told you, right? This company is only catering to this segment, whereas the market caters to the entire of India, whereas my company is catering only to Tamil Nadu or only to the south or only to the north. So you estimate a certain 1% or 2% and try and add it to your cost of equity so that your cost of equity is relatable to the specific valuation that we are doing, right? Now, in most of the cases, how do we get this data, right? How do we get these data of risk-free rate, beta value, market rate of return, and premiums and things like that, right? So risk-free rate, like I told you, I generally use the 10-year government rate from the net. With respect to market return, your country risk premium, your industry beta, okay. One, you can try and take for if you identify comparable companies, you can try and take the betas of the specific companies from your from the net, okay. You can also try and take the equity risk market return premium that is required, right, from data sets of Ashwath Damodaran. So Ashwath Damodaran is a renowned valuation expert who takes classes in New York Stern University, and he every year releases data, right, which is used by the income tax department, which is used in a lot of cases. It's like a trusted data which. So his data is really detailed and very interesting and very useful. His data gives you the market premium that is associated to a specific country, to a specific industry, right? He has segregated it industry wise. He also gives the beta impact. He also gives what is the debt equity ratio that is used to arrive at that debt equity, arrive at those market premiums. So you can use that data and change it accordingly to your company specific or business specific valuation. So for both beta, sometimes I use the market data of listed companies where I'm doing valuation of bigger companies, and it's easier to compare, right? For private companies, I try and take the beta and the market premium from the data sets of Ashwath Damodaran. And in some cases, when the data is too tricky, or when the valuation is too tricky or is not comparable at any way, or the industry is not very clear, right? I just use a beta of 1 and ensure that I'm just telling that my market premium, there are no changes to the market premium, or I'm not able to estimate it clearly, right? So this is where I take the data from. Small company risk premium and company specific is very judgmental in your own estimate. So this is again a subjective premium. You can assign based on the level of the operations, the place at which the company is in right now, right? Being a startup, you can have a very high small company risk premium or a company specific risk premium. If it's a mature company, it might be lower, right? Or you might not even consider for a company which is at a stable stage, right? So these are the things you need to factor in determining your cost of equity, right? The next segment, the next big segment under your DCF valuation is your terminal value calculation, your perpetuity formula, right? So see why terminal value is because you need to determine a value for a going concern company beyond 5 years. So there is a perpetual period which you need to value other than the 5 years, right? So generically, there are multiple ways to determine the terminal value. You can use methods like exit value, right? Determine that if the business is sold at 5 years, or you have a proposal for buying this value after buying this company after 5 years. So you can use that as that exit value as a terminal value, okay? Or you can use um, other fair value mechanisms and determine the terminal value. But predominantly for a going concern, for a stable growth or a growth driven projection, we try and use the Gordon's formula to determine the terminal value, okay? You should, after using this formula, after determining the terminal value, you should discount the terminal value and add it to the 5-year discounted value, right? So you should ensure that you discount the terminal value, right? um, One second. So the most prevalent is the Gordon's growth model, right? So Gordon's growth model is where you apply this formula of 1 plus growth rate. It factors in the growth of the company, right? So it is 1 plus growth rate divided by your weighted average cost of capital minus the growth rate. So here in this, it can be weighted average cost of capital or the cost of equity in whatever scenario which we use, right? So this factors the growth which we are projecting, right? Now, interesting part is how do we determine this growth practically? Okay, the formula is fine. It's just 1 plus growth divided by weighted average cost of capital minus growth, right? What is the logic behind determining this growth rate, right? See, the logic is generically you try and understand the business and the industry, but when you're going to project for a perpetuity, you should consider the higher macro level, which is your country and the region that you are catering to. So usually this growth rate will be in between inflation rate and your GDP, the country's GDP growth rate, right? Because you're telling at the long run, if you average it out, my growth rate is going to be very similar to the country's somewhere between inflation rate and the country's GDP growth rate, okay? This is the broad logic to that for any stable company. However, you can assign higher growth rates for startup companies, which are going to be much higher than the country's GDP growth rate. But logic sense is that because we are averaging out, because we are doing it for the perpetuity, right? You cannot have a very high growth rate for the terminal value. It should usually be in the range of your GDP growth rate or in between your inflation growth rate and GDP growth rate, right? So because your GDP considers lot of industries and lot of factors which go into the country's GDP growth rate, you can justify saying that for these reasons I have used a higher growth rate, and because you are just it all boils down to your subjectivity and your assumptions, right? So you just explain saying that for these reasons I'm trying to use a higher growth rate because I believe that the company is going to grow more than the GDP rate of the country, because this industry is like that, because at a country level it's an average of industries, right? So there could be certain industries which have a higher growth rate as compared to other industries. So this is something practically you can try and ensure that you are well within that ambit of using the correct growth rate for Gordon's growth formula, right? So like I said, from a holistic approach, so how does this DCF work? Like first we have your um, projected cash flows. You discount your projected cash flows for the first 5 years, and then you the discount rate that you use will be based on the debt equity ratio, whether you should use weighted average capital, cost of capital, or your cost of equity. And how do we determine cost of equity? Is you look at the risk-free rate of return, your market premium, and other things like that, right? And then you determine the terminal value. You add the present value of the 5 years cash flow and also the discounted terminal value. This gives you the value of business. And like I said, now you should ensure you do this other value adjustments like key percent discount, or control premium, or a lack of marketability. And you also consider other value adjustments like your non-operating assets, right? So this A plus B plus C gives you the value of business. If you reduce debt from this value, you arrive at the value of equity holders, right? So this is a broad scenario to arrive valuation from a DCF method. And I think I wanted to touch upon the practical aspects in each of these things. Now my objective is we should all know why why we take this rate, and just not pick the rate from the net or from the without realizing what impact it has in our valuation, right? Now the other approach that I try and do always is that I try and see if the business requires multiple methods to value the business, right? Can we do only DCF, or does it also require asset uh, um, net assets value, right? So that entirely depends on the case to case basis, where if you feel that the non-operating assets are very high compared to the operating business, there could be a lot of cases where, for example, the factory land, the market value of the land could be significant as compared to the business happening on that land itself, right? There could be a small business that is running, but whereas the market value of the land could be significant. But but the end of the day, the land is in the company's name, and then you're trying to when you're trying to do a value of the share, you should consider the value of the land, right? But then you should also determine how do you want to give weightage to DCF and your net assets, right? Or you try and add the value of the land to the DCF valuation, treating it as a non-operating asset. So first thing is that you try and see if we need to do a mix of multiple approaches, right? Second is I generally try and do this relative method, right? I try and see this thumb rule, or market multiples or market transactions, to ensure that my valuation is coming on par with them, right? See, because end of the day, if you're too different from the market, either you need to have a very clear justification, or you're wrong, right? Or you could be wrong, right? So generally, like when I try to do a valuation, I try and relatively check how is it comparing to the market, right? With certain multiples like revenue multiples, or EBITDA multiples, or um, like PBT multiples. So I try and fix those multiples and try and see, okay, are we in the range? If we are different, do we have right reasons for it to be different? Okay, my capex is higher, so maybe my EBITDA is lower for this industry. although I'm in the same industry, my company, my EBITDA is lower, so maybe the multiple is like this, right? My revenue is higher, but my profits are lower. What are the reasons deriving to a different valuation? Like when we are trying to do, I also see now information is available on a lot of acquisitions by funds and other private equity players and people like that. It's very easy to get that information because you will be able to get it from ROC itself, from the past 3 which they are filing. You just multiply into number of shares and this thing, you can broadly arrive at the business value that they are getting, because you will get a news that they're taking 10% value for so much value, 10% share of so much value. So you try and, on a rule of thumb basis, try and see if it makes sense, right? That valuation, what somebody is invested actually in such an industry or such a market, and then you try and determine whether your valuation, your scientific approach to this valuation talks to that rule of thumb valuation, right? So you try and see if that is helping more or less talking to the market. So that I would always suggest you try and have a relative approach to your scientific approach, right? Okay, like I said, you can try and compare it through revenue multiples. You can try and compare it through book value to market value. You can try and compare it to your earning multiples like PE or EBITDA multiple, okay, or anything like industry specific variable, like if it is very capital intrinsic, right? You generally have a revenue to capex ratio. For example, in an industry like QSR, like where you need to keep QSR is a quick service restaurant, where you have small restaurants that are coming up, right? Like let's take for McDonald's or KFC. So assuming if one person is putting these stores and capex is involved in each of these stores, like you should know that your capex should generate so much of revenue. So there is a multiple associated to the capex. So you can see if that as a rule of thumb is matching to your scientific approach, right? So this is one other practical aspects that I try to bring into my valuation whenever I complete a valuation, right? So of course, when you try to assign okay, so the other ways, for some startups and some early stage for investment purposes, we try and use a multiple method straight away. Like instead of DCF method or instead of net assets method, we took this relative approach of comparable companies, multiple approach method. But when we use that, it is an acceptable approach. It is a widely used approach for a lot of startups, right? But the only challenge here is we should ensure that the fundamentals are right. The fundamentals of the comparable multiples and your comparable companies are very similar, right? And try to see what kind of multiple suits. Like is it the revenue multiple, or is it the EBITDA multiple, or is it EBIT multiple, or your capex multiple? So try and see which suits you, and always try and have an average of multiple companies when you use this method, right? So you can simply value a company by saying that these are the comparable companies that I've identified. Recently they have been recently their valuation are this based on their revenue, so I'm going to use a revenue multiple. My revenue is this much, so I multiply my revenue, I say this is my valuation. Here the tricky part is, what revenue should I use? Should I use my current year revenue, or my next year revenue, or my revenue after 5 years? So like I said, the fundamentals should match. If the valuation you're using is that year's revenue for your comparable, you should also use your own revenue, or should try and say that they have used that multiple because they are at this size, but whereas I am not at this size, so I'm not going to use that multiple. I'm giving a discount to that multiple. So instead of using 4 times of revenue, I'm going to use 3 times of revenue. So you can justify like that as well, and do valuations for a lot of startups, right? So it is an acceptable, but you should have very clear justifications in your report, right? So just on a conclusion basis, so you have this income approach, asset approach, market approach. Like I said, you try, and it's not, there is no hard and fast rule, or there is no the right way, because your purpose of valuation and your assumptions can have a factor in changing the valuation methodology and the value itself, right? But nevertheless, when we follow the process that we have discussed here, and ensure that in every assumptions we are trying to have reasonableness to that assumption, and it's not too far away from market or other transactions that have happened, then the difference should not be high between two valuers, right? Although there will be difference, but the difference should not be very high, right? When your approach and when your process is the same. So try and ensure that you follow the process for any valuation that you do, starting from what we discussed of analyzing the industry, business, outside external factors, then getting the information, doing due diligence on that information, arriving at what is the best approach that you need to follow, best methodology, justifying your reasons for that approach and methodology in your report, listing out the assumptions, and ensuring that assumptions are close to reality and close to the market and the industry, right? When you fix all this, I think we are on the right track to give a fair and true and fair valuation. We have done a true and fair valuation exercise, right? On the last part, I just want to quickly cover there are valuation standards, and what we have discussed now is what is getting covered in these valuation standards in a very sophisticated manner, if I can say that, right? So what we have discussed is not entirely just a practical thing which we can follow blindly. No, these are all coming from valuation standards, different valuation standards, and whatever we have spoken are part of the valuation standards. So you can read through the valuation standards to get more guidance on how to do valuations, right? And we have you have 101, 102, 103 definitions, valuation basis, valuation approaches, work, reporting, right? Business valuation, and then you have intangible assets specifically, then you have for financial instruments, right? So you can go through these standards to get more insights and more guidance on specific this thing. But please go through these standards, because these standards lay down a lot of principles, lot of guidelines in, and they have a lot of examples. They do give a lot of insights into specific situations. It is very similar like our accounting standards, where we go back and check when we do our audits and accounting, right? So it's very similar. It's not that these valuation standards just give a broad overview and then they don't give any specific. No, there are a lot of examples, there are a lot of specific situations, a lot of situations are covered. You can also reference to international valuation standards, right? They also give a lot of insights to specific situations, specific criterias, and they are evolving. There are recently there are new valuation standards that have come out. So you can go through and then try to see if your situation fits into any of the specific guidance given there, which will be very useful to do a very objective valuation. Okay. I think that's it from my side. I just wanted to concentrate and give you guys the practical aspects of the valuation. I hope I've imparted some interest or curiosity in for people who are not yet registered valuers to get into or becoming a registered valuer, and people who are already a registered valuer, probably you've learned additional 2-3 things which I follow, or which we from a practical perspective, which you can apply it in your valuation. And I thank SIRC and the Institute for this wonderful opportunity. Feel free to ask your questions. I'll try to answer them with my limited knowledge. If not, I can try and get back to you later as well. Thank you.
Thank you, sir.
Yes.
Thank you,
Thank
sir.
you,
Thank
sir.
you.
We have some questions. So can we take it up, sir?
Sure.
1 minute, sir. Just
I'm basically a max graduate. When I was studying this vector algebra, I'm reminded of your subject where I studied vector algebra, because the vector algebra always speaks about the directions which you only have to go by an imaginary value.
Correct.
Most of the things what you are speaking is only about imaginary things, and
True.
of course we need to get
There is a lot
ourselves
of
updated.
subjectivity involved. Yeah. Yeah.
Yeah.
So
You can take up the
one,
question.
yes, sir, done.
Whether
Whether
valuation,
valuation by a registered valuer for preferential issue of debentures and shares is required. Yes, I think the Companies Act requires valuation report for issue of debentures, be it NCD also. Surprisingly, it is required. The reason being that there could be convertible debentures which are converted to equity, right? And there are also preference shares which can be converted to equity. So as such, issue of shares is needed, and preferential issue. See, you're just, like I said, the purpose is preferential issue. You have determined the valuer. I mean, you know that this person is going to invest for a specific purpose. Accordingly, you prepare the valuation, factoring the specific purpose, right? When is it mandatory for a merchant banker to do the valuation, or all merchant bankers considered RVs? Is there any difference in the valuation methodology between merchant banker, registered valuer? Okay. Firstly, you can be a CA, you can be a CS, you can be a cost accountant, but end of the day, if you want to value inventory, there is only one standard, right? So you'll have to follow that only. Similar to that, you can be a merchant banker, you can be a registered valuer, you can be a CA, but end of the day, there is only one process to valuing a company or a share. So that is one. Second is, merchant banker can do the valuation under Income Tax Act and under FEMA. Okay, so FEMA agrees both CA and a merchant banker. Income Tax Act unfortunately requires merchant banker when you're valuing through DCF method. See, income tax valuation is only required for your section 56 purposes. Okay, where you can't issue shares lower than your fair market value, or difference is taxed, right? So that is so only income tax requires merchant banker, but the method of valuation and your process to valuation does not differ between a merchant banker and a registered valuer. They also have to follow the same standards, same they also have to do everything what we have discussed today, right? So third question is how the startups are valued without any fundamentals and purely on speculation. Further series funding methods and challenges for that. So this question is like, how are you? Like every evaluation session, this question is being asked. Sir, it's a right question also. See, it might sound surprising that some startups are absurdly valued. Yes, some startups are absurdly valued. Not only startups, some listed companies are absurdly valued, right? So valuation, there is a market sentiment from a listed company perspective, right? But I learned this very nice quote when I studied for valuation, right? Your cash is king, right? That doesn't mean that cash needs to be right now. You're estimating, so you're only assigning a value for your future cash flows. Okay, so this future can be 5 years for somebody, 10 years for somebody, 20 years for somebody, right? You take a typical Amazon example, right? You take Amazon business in 1997 when they started, in 2000s, and where they are now. And for some investor, he'll be willing to pay a higher value because he is able to see this vision of post 20 years how this company can become, right? And similar thing happens here, right? And when you see the startup ecosystem, right, nobody invest only for the current product or the current business which they do, no, right? So they always anticipate the future. For example, classic example, Byju's, it's extremely valued, but can we say high right now is you might feel it is high, but you never know, because today Byju's is sponsoring Qatar World Cup. Okay, and imagine the reach of Byju's after sponsoring Qatar World Cup. And end of the day, look at the, imagine if he can become the Amazon of education, online education, because 1 + 1 is 2 anywhere you teach. So education is the same. It's not like and he's not teaching only Tamil and Marathi or Hindi, which is very specific to India. He's teaching math, science, which is the same across, right? Imagine he's able to tap online education across the world for a 7 billion population, right? So that's where the expectation is. Like tomorrow, Byju's can tap into the entire world, tap into the, and that's the value. And same value you take WhatsApp, right? Facebook bought WhatsApp for $19 billion, but WhatsApp had no revenue. But so you can't associate only cash flows to valuation again, right? But the point is, Facebook is making money using the data of WhatsApp, and his future is today. He's tied up with Reliance, where your JioMart is fixed in is integrated to your WhatsApp, and you have WhatsApp Pay. WhatsApp Pay can become like bigger. So it's all expectations, and in future all these can generate cash. So that is where your startups are valued very high. Only thing is that I will disagree saying that it is without any fundamentals or purely on speculation. No. So nobody is going to put money if they're not going to think they're going to get that money return. Everybody wants returns. So it is not without any fundamentals or speculation. It is only that we are not able to see that fundamentals as a third party, outside third party. Now, how are these discounts measured? Say, next question is, how are they? I'm not too sure. I'm assuming you're asking about cost of equity. Like I mentioned, cost of equity factors the risk-free rate, your risk premium, which is your difference between market rate and risk-free rate, and your country risk premium, right? So you have your specific company risk. So this is how you assign and determine your cost of equity. Right? Is it necessary to perform the valuation aspect based on audited financial statements? No. See why? Because your valuation date can be anything. It can be 15th April, it can be February 22nd, it can be June 23rd, right? So you need to get a provisional or unaudited financials as of that date. You can rely on provisional unaudited financial information, because your end of the day, you are getting the past audited numbers, and then you're trying to analyze all these trends, and then they're ensuring that this provisional makes sense and your projections make sense, right? So you can use, even for 11 UA, you can use an unaudited income tax act. For this also you can use unaudited balance sheet as at the valuation date, because you need to segregate your non-operating assets, your operating assets. So you need to mandatorily get a provisional financial statement as at the valuation date. Next next question is how to get industry-wise equity beta. So I use Ashwath Damodaran's data, which gives me industry-wise equity beta. You can change that beta based on the debt equity ratio of your specific company. So there is a formula because there is a leverage beta, unlevered beta, right? Leverage is nothing but when the industry has both debt and equity. Unlevered is when there is pure equity. So you can use Ashwath Damodaran's data. You can search. It's freely available on net, and it's an amazing data set which he gives. Otherwise, you can take it from for equity companies. There are certain reports which you have to pay and get, which gives you industry-wise beta. But otherwise, the best way to take is Ashwath Damodaran data. Please repeat his name. Yeah, his name is Ashwath Damodaran. He is a professor in New York Stern University. What's your opinion about startup valuation with aggressive marketing? So, like I said, your startup valuation is based on the future, right? And to build a brand, you always need marketing. You take anybody, you take Hindustan Lever, you take Reliance, everybody spend on marketing to build a brand, right? We only assumed, it's only a conceived perception that only these startups and these new age startups and new age investors are pumping in money for aggressive marketing. No, Reliance also does the same thing for Jio, did the same thing for Jio, right? He just gave free SIM cards, free data, and then now market is reacting to that. So all the initial costs are for marketing, right? So it all depends on how confident somebody is about the product and how they think the market will react to that product, right? Next question, any specific site where we get data for various industries? Again, Ashwath Damodaran, you just search in Google Ashwath Damodaran data, you will get all the data. In fact, he gives data like revenue multiples industry wise, EBITDA multiples industry wise, cost of equity straight away. But I would suggest you use the equity premiums and determine your cost of equity based on the CAPM method. Beta you can use, but don't just take blindly the cost of equity which he is giving, because it may not correlate to the specific valuation that you are doing, right? What's the most suitable method for valuing intangible assets? Sir, intangible asset is like your replacement cost or your cost incurred till date, okay? Or if you can specifically do a royalty licensing agreement, that's the best method. Second approachable method is your replacement or the cost you've incurred to build the brand till date, right? Or somebody would need to spend so much to build this brand to where it is. That could be. Third approach is you can again treat it as a cash generating brand. So with this brand, you can estimate your revenues and cash flows and then go back to discounting cash flow method. So any Microsoft Excel template? Sir, unfortunately, there is no Microsoft Excel template for DCF, but it's a very simple projection to discounting, right? It's very simple Excel mathematics. Why I'm telling it is no, you can find some things on net, but it might not cover all the aspects which you need to factor in for your specific valuation, right? Why? Because there could be non-operating assets in you which you need to add to the discounted cash flow for the business, which may not come in the format or this thing. And I would strongly suggest you try and put those formulas, because that helps you in understanding the valuation better, rather than just putting the discount rate in a cell and then that computing the entire data, right? You try and do that 1 plus or in the Excel formula, because that is how we ensure that there are no mistakes in the valuation that we do, and we try and learn, and you will appreciate the difference or the impact your valuation has when you change certain things in a last year cash flow or your discount rate when you do the Excel template on your own. I think that's about it on the question side. I hope that I've reached my objective of imparting that curiosity and adding value add to people who already know most of these things. So I thank you so much for this opportunity once again, sir. Thank you, Sundarajan sir.
Thank you, ma. Thank you, Keerthi, Ganesh sir. You have presented it so well, and it's a specific specialized subject, and you have handled it so well, and you have given them I think that the questions shows that the people are also aware of this, and they have asked you so much of questions. And it's good that the SIRC is doing such a beautiful program specializing on a particular subject of valuation, which is especially on shares, where of course I don't do deal in any shares. So I don't know anything about the shares. So, but the people are there. Most of the people I have seen, even in our institute and the other colleagues, they deal only in shares. I've seen most of the people doing in shares. Yeah, nice, Keerthi, Ganesh sir, were very well presented program.
Thank you.
And a very well attended program also. I thank all the participants who have participated and got enriched on the subject. I thank the office, Selva, for giving the kind support and everything. Thank you, sir. Thank you so much, sir. Nice.
Thank you so much.
Thank you, sir.
Bye. Selva, can we close?
Close it off. Thank you, sir.
Yeah, thank you.
Thank you, sir.